The consumer scaling back with retail sales rising just 1/10 of a percentage point in October, missing estimates. I'm joined now by David Lebovitz, global market strategist at JPMorgan Asset Management. All right, David, retail sales taking a hit this month. Is there a more broader fundamental issue here, or is this just the consumer taking a pause to gear up for the holiday shopping season?
I think this is really just the consumer taking a pause. When you look at the year-over-year numbers, we're still seeing very strong growth in auto sales. We're seeing very strong growth in spending at restaurants and drinking places, as they call it. So, we are seeing that consumer story continue to play out. We've seen very strong consumption over the past couple months. So I think this is nothing more than a pause, as you said, Scott, as consumers prepare for the holiday retail season.
All right, and of course, we've been seeing some major retailers like Macy's struggle as of late.
Yes. One interesting thing about that is companies seem to understand that the brick and mortar approach to sales doesn't hold as much weight as it used to. And you see these companies embracing online sales more, embracing discount stores more. So I think the nature of retail may be changing a little bit, forcing a lot of these companies to adapt.
All right, now with just 1 month to go until the Fed's December meeting, of course, we have another jobs report coming up, some inflation reports, but the markets, though, are pricing in a 70% chance of a December liftoff. So do these upcoming reports even matter?
So I think these upcoming reports do matter. There are 4 or 5 weeks until the Fed meets. A lot can happen in that span of time. Let's not forget, although the October employment numbers were very good, August and September were pretty disappointing. There is a chance we could see another disappointing report, which could cause the Fed to reevaluate their trajectory. However, from where we sit, we're in the same camp. We think about a 70 or 75% chance that the Fed goes in December.
All right, and James Bullard at a conference on Thursday, who is a hawk, repeated his calls that the Fed should move on interest rates with an eye towards the December meeting.
Exactly, and based on some of our models, we see inflation gradually rising to about 2% in March of 2016. Monetary policy operates with a 6 to 9 month lag, which means if they raise rates today, it doesn't really hit the economy until 6 to 9 months from now. So with inflation looking like it's headed higher, with full employment, given our 5% unemployment rate, and relatively robust job creation, I think that it's a good time for the Fed to move.
All right, finally, let's talk about Europe. GDP in the Eurozone rising 0.3% during the third quarter. That's missing estimates slightly. So 2 questions here. First, does that set up more stimulus from the ECB in December? And 2, their meeting is just a week before the Fed's meeting, so should we be drawing any link between the two?
I think it definitely sets the ECB up for more easing in December. Right now, we're looking for them to cut interest rates marginally and possibly expand the asset purchase program by about 5 to 10 billion euros. So we do expect more easing out of the ECB. The implications of that for the Fed, if the ECB eases, that puts downward pressure on the euro, which puts upward pressure on the dollar. One of the things that has kept the Fed at bay thus far is the strength of the dollar. So I think it's going to be very important to watch currency markets as we approach those December meetings to get a sense for how different central banks are going to handle strength and or weakness in their given currency.
All right, David, we'll be watching. David Lebovitz, global market strategist at JPMorgan Asset Management. Thanks very much for joining us.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.